Good morning, guys. It's just about 10 o'clock, so I'm gonna kick this off. Firstly, thank you for everyone who's joining us for this edition of our webinar series. I think this is going to be the third one we're doing for the year, and we're talking about something that's quite hot, both, I guess, pun slightly intended. Inflation, as you guys have been seeing across the world, has been running high, and we're going to talk about what that means for us in the FX world. So let's crack on. So just to go through, we'll introduce what inflation means and go through that. We'll talk about what central banks are doing to control inflation and what that's doing for growth, and then specifically talk about interest rates, why they're going up, and the impact over the next couple of years on the currency markets. So let's have a look. So inflation, if anyone here is unaware of what that is, it's basically the rise of prices of goods. Basically, things are getting a bit more expensive here in Australia. Lettuce has been a good example of what we're talking about. But really, that's been driven by a few things. It's been driven by cheap money for a long time. So as we know, interest rates have been really low. It's been driven by the oil crisis that we're seeing at the moment. The war between Russia and Ukraine's really impacted the price of oil. It's consistently above $100. If you're going to the pump at the moment, I think you're paying close to $2.50 for E10. So quite expensive there. Also, we're talking about, a change from more fossil fuels to a more greener economy, and that takes a lot of capex, and that's really impacting prices as well. So what we'll talk about is how central banks are turning more hawkish. Hawkish means raising interest rates. And the impact of that is possibly a recession. We'll give you our views on the recession. Our view at the moment is that a technical recession, which is technically 2 quarters of negative growth, is avoidable, despite what you guys are seeing in news and in headlines. I believe it takes a lot to see 2 consecutive quarters of economies growing, slowing down globally. So why are central banks raising rates, and who are raising rates? So if you have a look at it, the Bank of England and the RBNZ, they were the first central banks to raise rates last year. Despite them raising rates, we're still seeing inflation way above their target level. Typically, central banks have a target between 2 and 3%. The RBNZ is at about, I believe, 6.5%, and the UK are at about 8% inflation at the moment. What that means is we're still going to see quite aggressive hiking, not only from those 2 banks, but across the globe. Australia is quite interesting in the fact that we expected the RBA to start raising rates in 2024. We didn't really see that, though. We saw them raise rates in April, and most likely we'll be seeing them raise rates throughout the year. The only 2 central banks that haven't done it is the ECB, which is the European Central Bank, and the Bank of Japan. The ECB, I believe, though, will be catching up with us, and we might be seeing a rate hike very soon from them. But what's the impact of raising rates, right? Raising rates typically means that money's more expensive. Mortgages are a little bit more difficult to service, and basically we typically see a retraction in economic growth. That's why we have fears of a recession. And now that's being widespread across the globe, purely because we've had a period of low interest rates for such a long time. But I think people need to acknowledge that interest rates are still low. They're still close to record lows. We're not seeing interest rates close to 4 or 5% from the central banks. They're still around that 1 to 2% mark. So it's still slightly expansionary relative to where interest rates have been in the past. So what happens when rates go up and recession fears are high and inflation keeps going up? We typically see a flight to, risk-on assets or safe haven assets. One thing that you guys would have learned over the webinar series that we've done over the last couple of years is we normally say that the US dollar gets bought in times of risky times, and the Aussie gets sold. If you guys recall, the first quarter of the year, the Aussie actually outperformed. That's really driven by commodities, but now we're seeing more traditional risk-off moves. And if you could see by the dollar index, it's hit quite record highs. I think 104 was the highest it's been for quite a long time. And year to date, it's up to 10%. That 10% move is really correlated to the sell-off in equities, heightened risk tensions. The Russian-Ukraine war as well is really showing that when times are scary, people do run for the USD. What's happening in Japan at the moment is also driving that as well. With the Bank of Japan remaining dovish, not choosing to raise interest rates, has seen the USD become the preference currency. So those of you guys here that are exposed to the USD and it's the new financial year, I was speaking to a few clients and everyone's thinking, can I still budget at 70 cents? I think you might be able to, but at least for the next 2 quarters to start off the financial year, it might be difficult. We've been seeing a lot of revising of budget rates to around that 68 to 69 level. I think that's where we're currently at the moment. That being said, we're slightly more optimistic in terms of this recession chat that we're seeing. So look, we're not going to be sitting here and saying that, you know, we're definitely going to see a recession. It's going to hurt for the short term, but from 2023, we see some positivity there. Like we said, the USD has really come into power over the last few months, identifying it as a risk on asset. And if you guys want to point any fingers to what's going on there, like I said, Russian-Ukraine war, commodities rising, and basically just more heightened risk off. Everyone's now concerned about inflation as that's more in mainstream news. So let's talk about inflation a little bit more and let's understand what's driving that, why we're seeing inflation across the market. So if you guys recall last year, the Federal Reserve governor kept saying that inflation was transitory. Transitory means that it's only going to be here for a short period. However, it's continued to exceed expectations in market. That's from the end of last year to now. A really good indicator of that is Citigroup's inflation surprise index. Basically, that's how many times an inflation print has gone past what economists, what the ABS, what economists is thinking inflation is going to be. I think over the last 6 months, we haven't had a CPI reading, an inflation reading that was at the print. It's always exceeded the expectation by a little bit. And that just shows that, you know, people don't know where the markets are going. People are probably underestimating the inflation that we're seeing, underestimating the savings that we've seen through COVID and the spend that we're seeing in market at the moment. So 3 key points to what's driving inflation. Like I said, the pent-up demand, the pent-up savings. Everyone's traveling and spending a bit more at the moment, especially as the world reopens. What's happening in China, where everyone else is reopening, China's quite concerned about COVID still. And as we know, a lot of our goods, I believe 80% of imports from to Australia come from China, and that's really slowing down supply chains. You guys on the ground would know that very well. Lead times have gone from about 4 weeks to 4 months at times, and things are just getting a little bit more expensive to ship from over there. And other things to support, like I said, rising commodity prices and the Russian war on Ukraine. So going back on what central banks are doing and what inflation looks like, have a look at this chart, right? You can see if you take an assumption that central banks have a target of 2 to 3%, pretty much every central bank is, every economy is past their inflation target. The US, the Eurozone and the UK are something to highlight. What's positive about here in Australia? We're at 5% year on year, which is still, you know, within reach to control. So possibly, as much as we're seeing forecasts and economists and the news saying that we'll see more rate hikes, if inflation starts to get controlled over the next coming months, we've got 2 inflation prints left for the year. If they do come in maybe around 5 to 3%, we might not see the rate hikes next year, but we'll have to wait to see what those prints look like. You guys would have heard me talk about commodities in the past. Typically, we would say that a rise of commodities will see a rise in the Australian dollar. However, what we're seeing at the moment is we're seeing a rise in energy commodities. Australia is typically tied to iron ore and the rise of iron ore. What we're seeing from energy commodities is a rise of oil and gas, really driven by the demand or the supply not coming out of Russia. But what we're seeing with iron ore is that steel mills in China are starting to slow down. We're coming off about a high of about 150 this year, close to about 112, 120 at the moment. What does that mean? That means more pressure on the AED. So pressure from risk off scenes that we're seeing at the moment, and pressure on basically a fall of commodity of iron ore demand is really seeing that Aussie find its footing around 70 cents against the USD. So let's have a look at commodity prices. Like we said, oil and gas is quite high. Oil kind of peaked at the start of the war about 125. Gas peaked at about 200, again, at the start of the war. Why we're seeing a cool off at the moment is the European summer. Typically, the demand for gas and oil is lower at that time. The focus at the moment in Europe is to increase the reserves and increase their stockpiles, so that when we go into winter towards the end of this year, we may see a cool off in prices. That's what the markets are saying. I think a little bit differently. We're slowly going to be shifting into a more greener way of living. And that only means that the supply of oil and gas is only going to start falling down. So my view, these graphs that you're seeing, I think they're going to stay at those levels, probably get more expensive on the way out. What that means for us is inflation that we're seeing at the moment won't be transitory and will be here for a longer period. By the way, if you guys have any questions, I don't have time for questions in this webinar, but at the end, you'll have my email and you can flick that across and we can answer them directly to you guys. If you guys are a client of us, you could reach out to your client manager and they'll be able to answer some questions for you as well or connect them to myself. So let's have a look at other economic data. I know that we're focusing on inflation, we're focusing on interest rates, but a lot of those decisions, especially with interest rates, are driven by, more minor economic data that we look at. One of the biggest ones that we see or that we look at is PMIs, the Purchasing Managers Index. Basically, that's an indicator of how much corporate spend we're seeing at the moment. The number that we look at is 50. If it's above 50, we see that as expansionary. It means companies have cash, cheap cash, and are spending. A number below 50 is contractionary, meaning that, there's more of a shift towards saving or cost cutting. A lot of correlation there between cheap money, interest rates, and that number. Also, what we have been looking at is consumer confidence. Now, we may see that fall as savings and basically the view on market slows down. But right now, that's still relatively healthy, especially post the COVID pandemic that we saw over the last 2 years. So let's talk about PMIs again, have a look at that chart. We always look at 50, that brown line. You can see that we're slowly coming back down below that number, which means inflation is somewhat controlled at the moment. We've only seen PMIs below that number over the last 2-3 years. The first time was when the pandemic first started, and the second time when the Delta outbreak started to come out. And we kind of went into that second round of lockdowns. Talking about consumer confidence, you can see the charts started coming up. So we're seeing high consumer confidence as we reopened in the economy, not just here in Australia, but across the globe. Or a lot of correlations there are travel, spend, and basic comfort in employment. What we're seeing, especially this month in Australia, you'll probably see on your social media sites, a lot of people are traveling and going overseas. So that's what we're reflecting at the moment. Our view is as we come back to the first quarter of this financial year, we might see that confidence slow down as savings have been depleted from the last 2 years. As well, despite rising inflation, we are seeing other indicators saying that the economy is slowing down. So as goods are higher, We're seeing consumer confidence go down. We're seeing confidence in the equity market slow down as well. In Australia, it was in the financial year last year. I think we fell down close to 9%. It was the first year in a while since we've seen a fall in the Aussie stock market. At the moment, the S&P is down 20%. So we're really seeing a slowdown in confidence, in investor confidence as well. Again, goes back to what we spoke about, driving the USD and selling off the AUD at the moment. Goes to the big question that we have been asking, that has been on the news. A recession, is it going to happen? If any of you tuned in to Governor Lowe's speech last week, he was really optimistic that Australia was going to avoid a recession. So technical recession is 2 quarters of a slowdown in growth. We think that since the economy is pretty tight, it's at a sustainable level. And with some savings, we may see 1 quarter of a slowdown, but we won't see 2 consecutive quarters of a slowdown. As well, in Australia, what's unique with us is we're seeing, as much as there have been a few complaints about what wage growth looks like from a minimum wage standpoint, we are seeing growth at that. So fiscal is trying to help out for households to manage the heightened cost of living. So let's look at the labor market. So you could see there that, we've never been more employed, I guess. In Aussie, we're at 4%. In the US, we're at a 60-year low of 3.6%. So it's really healthy markets. And that being said, there are still jobs out there. There's actually a shortage of talent rather than a shortage of jobs, which means companies have fared well outside or past the COVID scenario. They just need to weather the storm of slightly higher interest rates and maybe slightly lower demand at the moment. But overall, we've come out as a better economy with a very tight labor market. So just to cap out inflation and recessions, like I said, and you probably gathered by now, we are slightly more optimistic than what you see in the news. What will happen if we don't see a recession? We'll see the USD come off from its highs. Aussie should go above 70 again if you trade against that. As emerging market currencies and risk starts becoming more up in the front ground, you typically will see equity markets start to come back as well. Some people are saying that this is a buy the dip moment. I'm not too sure about that. But if your view is that we won't see, a technical recession, then yes, it's definitely a low point in the economy, and we should see a U-shaped recovery from this. Now let's focus on central banks. The 2 central banks we'll be looking at will be the Federal Reserve, the US central bank, and our very own RBA. You'd get very similar thematics to what I was talking about earlier on the view of why they're raising rates, what they're looking at, and what rate hikes we could see over the next 2 years. So we know that the Federal Reserve raised rates by 75 points last month. They said that could be a one-off, but they are at the moment raising rates as fast as they can. Now look into the future is the Bank of England and the RBNZ. The Bank of England's raised interest rates by 25 basis points in 5 meetings now. They're at 1.25%, and they're expected to continue that because inflation's still high. RBNZ, they, I think, are going to heighten rates by another 2% to control inflation at 6%. So looking at those 2 central banks, they started last year and they're going to continue, means that, central banks now have the same view that the goal is to reduce inflation. They must be in the view that even if they're raising rates by so much and so fast, it won't impact growth to drive a recession. So focus on the Fed. They're now at 1.5 to 1.75% in terms of interest rates. It was the largest hike since early 90s. We expect another 50 basis point hike or another 75 basis point hike in their next meeting in July. Why are we seeing aggressive hikes from them? Purely to control inflation. They would rather see a chance to get into a recession then see a chance of inflation last for a longer period and have that stagflation story. Now, stagflation is a different story. We're not talking about that. The S word's kind of a word that we don't like talking about. Basically, it's a period of high inflation, high unemployment. It's probably worse than having a recession. The good thing about the Fed compared to other central banks is that they have a dot plot. The dot plot adds transparency to what they expect interest rates will be. The last thing they want to be doing is to shock the market. Each dot represents a member of the FOMC, and it basically indicates where they see interest rates are going to be. Those little outliers down below and up above, they're your 1 or 2 FOMC members who have a different view to the rest. But typically, we see consensus across the members, and you could see there everyone expects interest rates to get to about 3.5–4% by 2023, and they're going to start pulling that back by 2024. So what's next? We see the Fed being at about 2% by the end of the year, closely in line with what the RBA will look like. If they don't raise rates as aggressive as what we're expecting, maybe see a pullback in the USD, maybe see a pullback up to 70 cents by November and December. Why? We're seeing 20-year highs rather. It's really this risk off tone. We don't see it lasting for too much longer, especially as we see a slowdown in rate hikes in the US and an increase in rate hikes out of the RBA, which I'll talk about next. So the RBA began their rate hiking cycle last month with 30 basis points. It was an odd number. I feel like they wanted to shock the market there, wanted to tell the market that they make their own decisions and they are aware of what's happening. We expect a 40 basis point hike next Tuesday. That's going to bring us above 1%, and that's going to address concerns of inflation, which is at 5%. It's expected to be higher at July's release at the end of the month. The goal is to bring that inflation back to target between 2 to 3%, just to make sure that, we are in front of the curve and we don't have to raise as aggressive as what the Fed did over the last 2–3 months. The goal is to get to basically 3.25% by the end of next year and possibly hold from there. If you have a look at, probabilities, you could see that we expect at least a 25 basis point hike for every meeting this year. That's not too aggressive. I think we'll see more aggressiveness if they are raising anything above that. But really, like we've been saying through this whole webinar, it's inflation that's driving the aggressive rise of interest rates. And with unemployment in Australia doing very well at a sustainable level, and inflation above the central bank's target, it's a no-brainer that we'll expect these rate hikes for the rest of the year, expected to continue till the middle of 2023. So, like we said, the Aussie is technically showing more risk of moves. We got to a high of about 75.5 at the start of the year, and now we're below 70 cents. Our view is if we see a reverse in the Fed and a continuing hike out of the RBA, this move is going to reverse itself, go back above 70, but there is downside risk to the Aussie. So if the RBA, let's say, don't raise rates as fast as they can, if global recession happens, so against our view, and global risk sentiment completely is tarnished, driven by more COVID or another strain of the virus in China that locks them down, then yes, the Aussie will fall down further. I guess that's your view to take on what you see the economy doing over the next 6 months. But our view is those 4 points that we spoke about, I don't think will happen or have a lower likelihood of happening compared to what we spoke about earlier. So we're technically bullish on the Aussie at the moment, seeing it close to 70 by the end of the year. That being said, I don't know where the currency is going. If you have a look at this forecast, this is something that we pulled from Bloomberg. Not many people know, or there's no real consensus for where the market's going. We have some forecasts all the way at 80 cents and some forecasts down to 61 cents. What we speak to you guys about and what we speak to our clients about is just having some type of transparency, hedging what you know, a bit more predictability in your FX forecasts, your FX cash flows. With the new financial year, it's probably great to focus on, setting a budget rate and having hedges around that. If you do want to know more, speak to your relationship manager, your account manager, and they could go into a bit more detail of what we spoke about. But I just love showing this at the end of every webinar just to show that some of the biggest and brightest minds in FX can't really decide where the currency is going based on this, fair value at 75, but could go as high as 80 and as low as 61. I guess it's your choice to choose. And that's it, guys. Thank you very much for jumping on. Our recording of this webinar will be sent to everyone. If there's any questions, you have our emails there. I'm happy to answer them today or straight after this if they're quite urgent. Thank you.